This video covers LIFO for inventory. LIFO stands for last in, first out. It's one of the 4 inventory cost methods. LIFO is the opposite of FIFO. The cost of the last units purchased go to the cost of goods sold, while the cost of the most recent units purchased are assumed to be sold first. The oldest costs are in ending inventory. Now let's go through an example of using LIFO. In May, Shade Company had a beginning inventory of 30 pairs of sunglasses that cost $10 each for a total cost of $300. During the month, Shade purchased another 20 pairs at a cost of $15 each for a total cost of $300. At the end of the month, Shade had 10 pairs of sunglasses left in ending inventory, having sold 40 pairs during the month. Calculate Shade's cost of ending inventory and its cost of goods sold for May. I'm going to highlight the critical pieces of information in that data set now. First, we see that the beginning inventory consisted of 30 pairs of sunglasses that cost $10 each for a total cost of $300. Next, we see that the company purchased another 20 pairs of sunglasses at a cost of $15 each for a total cost of $300. At the end of the month, the company had 10 pairs of sunglasses left in ending inventory. We don't know the cost of those sunglasses in ending inventory, so we are going to have to apply LIFO principles to get that cost. And finally, the company sold 40 pairs of sunglasses during the month. Again, we do not know the cost of those sunglasses sold, and that's why we are applying the LIFO method. We're going to start by summarizing the data in a table format. Beginning inventory was $300, which came from multiplying the 30 units by the $10 each. Purchases were $300, which came from 20 units purchased at $15 each. The total cost of goods available, therefore, was $600, which was the beginning inventory plus the purchases. The total units available for sale were 50 units, which came from 30 units in beginning inventory and adding 20 units of purchases. We will be calculating inventory and cost of goods sold. Now, I know there's a lot on the screen, but we're going to talk through it. Let's first start by calculating ending inventory using the LIFO method. Ending inventory is from the oldest units. See the beginning inventory line above. So its cost is 10 units times $10 or $100. Next, cost of goods sold starts with the most recent units. 40 units were sold, so all 20 of the units and purchases were sold, plus another 20 from beginning inventory to get the 40 sold total. To calculate cost of goods sold, you can also take the cost of goods available minus ending inventory, or $600 minus 100 equals $500. The second way is easier if you have the total cost of goods available. Just subtract the ending inventory cost from the cost of goods available to get cost of goods sold. Remember that beginning inventory plus purchases has to equal ending inventory plus cost of goods sold. And that concludes this LIFO example. Now let's compare FIFO and LIFO inventory methods from a couple of different standpoints. 1. Measuring cost of goods sold. How well does each method match inventory expense, cost of goods sold against revenue? LIFO results in the most realistic net income figure because LIFO assigns the most recent inventory cost to expense. In contrast, FIFO matches old inventory costs against revenue, a poor measure of expense. FIFO income is therefore less realistic than LIFO income. 2. Measuring ending inventory. Which method reports the most up-to-date inventory costs on the balance sheet? FIFO. LIFO can value inventory at very old costs because LIFO leads the oldest costs in ending inventory. Now, a word of caution. LIFO is not allowed if using International Financial Reporting Standards, or IFRS. This video was created and narrated by Dr. Sell-Tietz. Have a great day.